Online friends, am I audible? Please respond online. Online friends, please respond. Am I audible? Yes. So, I hope you have completed your lunch. I hope you haven't taken a heavy lunch. If you have taken a heavy lunch, then results will come out, okay? I'm sure that I can see the results in this session because this is the most dangerous session. Okay, this is the most dangerous session. Anyways, I will not sleep. Why? Because I'm keep on speaking, keep on talking. Make sure that you are also alive. Okay, whether it is sleeping, whether it is death, whatever it is, make sure that you are also alive. So, friends, we were discussing about gratuity, right? So, we haven't discussed gratuity. We completed our pension, right? Yes, yes. So, tell me, friends, what do you mean by gratuity? Now, we will discuss gratuity. What do you mean by gratuity? Gratuity means it is a gratuitous amount paid by the employer to the employee. It is actually a gratuitous amount paid by the employer to the employee at the time of retirement. Both the employee, say for example, the employee is not required to pay any amount to the employer. Towards the end, when you retire, the employer will give you a gratuity. Normally, it is a lump sum amount. Are you all with me? Are you all with me? Now, yes, okay. If I bring past foreign untaxed income to India in a PY, will it be taxable in India in that year? No. Past foreign untaxed means it is not the income of the relevant PY. If you want to tax something, it should be the income of the relevant PY. Then only you have to tax it, okay? Past foreign untaxed income means it is an income of some past year. That is untaxed in the foreign country. That you are bringing that amount in this year in India, you don't have to pay any taxes. Say for example, last year, I had an income from Dubai. In Dubai, it is not taxed. So it's a past untaxed income in foreign country. In this year, I bought that income to Indian bank account. For that, I don't need to pay any taxes. I hope it is clear. Okay. Yes. So moving on, friends. Where were we? Yeah. So we were gratuity. Yes. So gratuity means it's a lump sum amount paid by the employer to the employee gratuitously. And friends, listen, we can, from the perspective of, all the charts are from the perspective of income tax. Are you all with me? Are you all with me? From the perspective of income tax, you can split that gratuity into two. Number one, gratuity received at the time of retirement or death. Either at the time of your retirement or at the time of your death, you will receive a gratuity. For that, you can claim an exemption. For that, you can claim an exemption. And the second one is gratuity during the period of service. What is that? During the period of service itself, you can give a request for withdrawing the gratuity. Okay, during the period of service itself, you can take a request for withdrawing the gratuity, and that gratuity shall be fully taxable under the head salary. That simply means if you withdraw any gratuity during the period of service, that gratuity shall be fully taxable. You are not supposed to claim any exemption. Are you all here? Very good. And gratuity received at the time of retirement or death, you can claim an exemption. And that's what we are about to discuss right now. So have they updated anything related to the handout? Nothing. So in the next break time, please, I had a word with them. They told me that they'll arrange it by today, but GST instead of direct tax. My God. You got GST? Aha, super. Maybe they might come again. Some other classes material they today distributed. Okay. Anyways, you got a material, right? They only told me that they will distribute the material today. They didn't say that they will distribute DT material, but they have kept their promise. Okay. So I think I have to remind them again. So I thought they have distributed that material. It is IDT. Don't worry, you will get DT material. Okay. So don't worry. This handout is actually there. Okay, don't worry. Next break time, I'll update. Okay, yeah. Where were we? Gratuity received at the time of retirement or death. You can claim an exemption, and that's what we are about to discuss. Can you read the first box, friends? Can you read the first box? Employees of central government, members of civil services, local authority employees or defense services. You are a member of either defense service, central government, civil services, etc. Then you can claim an exemption. And how much is the exemption? Full exemption. That exemption, if you want to enjoy, then you have to withdraw the gratuity at the time of retirement, or you receive the gratuity at the time of death. It's not you, your legal hire, because you are already dead. Okay, you cannot come back from the dead and collect the gratuity and go again. Okay, that's not possible. If you are, legal representatives receive some gratuity, they also can enjoy an exemption. So I'll repeat that again. Employees of central government, members of civil services, local authority employees or defense services. You can enjoy what? Full exemption. So please excuse my dear online friends, because if I sit, I'll sleep. Okay. So I just want to walk around the classes. So please excuse me. I'll come in between. Okay. Yes. All right. So the point is, you can enjoy an exemption for the gratuity receipt if you are in that particular category. Now, if you are other employee category, you can divide that into two. What are the two division? Number one, covered by. Read. Covered by. Afternoon session, you must read. Whether you study it or not, you must read. Otherwise, you will sleep. Okay. So tell me, it is covered by Payment of Gratuity Act. What do you mean by covered by Payment of Gratuity Act? Very simple. Say for example, if you are running a factory or a company and your number of employees are 10 or 20 or more, depends upon the act, then that employer must give gratuity according to the Payment of Gratuities Act 1972. So if you are paying gratuity according to the act, then we can say that you are covered by Payment of Gratuities Act. Say for example, KS Academy, assume that they only have 2 or 3 employees. They have only 2 or 3 employees. The KS Academy voluntarily can pay what? Gratuity to their employees. Say, are you all with me? Say, I have 3 employees in my team and I'm voluntarily giving them what? Gratuity. That is also possible. If I'm voluntarily giving them gratuity, then we can say not covered by the Payment of Gratuity Act, but you are getting gratuity. You are not covered under any gratuity act and all, but you are getting gratuity. So if you are other category, you have to split that into two. Number one, covered by Payment of Gratuities Act. That means you are receiving gratuity on account of the act. Number two, you are not covered under any Payment of Gratuity Act, but you are receiving it. Okay, your employer is so generous, no problem. So in that case also, let's understand how to compute the exemption. So in the first category, how much is the exemption? Exemption shall be least of the following. If you are covered under Payment of Gratuities Act, you can enjoy an exemption, and the exemption shall be how much, friends? Least of the following. And tell me which all are the limit. Number one, rupees 20 lakhs, statutory limit. They are saying about a statutory limit. And how much is that statutory limit? Rupees 20 lakh. Number two, 15 by actual gratuity received is, condition number 2. What is number 2? Actual gratuity received. How much ever is the gratuity that you received actually is item number 2. And what is item number 3? 15 by 26 into last drawn salary into completed year of service or part thereof in excess of 6 months. Can you read that? 15 by, don't read 15 bar. Okay, it is 15 by 26 into last. It is T, okay. Last drawn salary into completed year of service or part there in excess of 6 months. What is this 15 by 26? Consider 26 working days in a month. Half the salary. Instead of that, if you are covered under Payment of Gratuities Act, they are saying 15 by 26. Consider 26 working days in a month. Out of the 26 working days, you take 15 days salary. It's a kind of half. But you have to strictly follow 15 by 26. Are you with me? Now, into last drawn salary. What do you mean by last drawn salary? What do you mean by last drawn salary? Before you retire or before your death, whatever is the last drawn salary, that into 15 by 26 into last drawn salary into completed year of service or part thereof in excess of 6 months. What does that mean? Say, I've retired after 20 years and 8 months of service. I retired after 20 years and 8 months of service. How many years we have to count? 21. Because completed year you have to take it like that. Part thereof in excess of 6 have to be counted as 1 full year. So 20 years and 8 months of service, I have to consider it as 21. What if it is 20 years and 4 months of service? 20 only. Part thereof in excess of 6. Something more than 6 have to be counted as 1 full year. Even if it is not, you have to count it as 1 full completed year. Are you with me? So you compute these 3 and pick the lower out of these 3, and that lower will be your exemption for gratuity received if you are other type of employee who are covered under Payment of Gratuities Act 1972. Is that clear? Now friends, there is a thing. Here also they have a definition for salary. Can you read the definition under that I have given? What is the definition? Salary equal to basic salary plus DA. They are not saying whether it forms part of the retirement benefit or not. In the last drawn salary, if there is DA, then you have to consider it. Are you with me? It is not standard salary. Okay, what they are saying is simply take your basic plus DA. If your last drawn salary have a DA element, you consider that. Last drawn salary definitely will have a basic salary. Okay, are you with me? All right, so that's what they are saying. So 3 limits. Limit number 1 is 20 lakh. Number 2, actual gratuity received at the time of retirement or death. And what is number 3? 15 by 26 into last drawn salary into completed year of service or part thereof in excess of 6 months. You can't hear, okay. Part thereof in excess of 6 means what? 20 years and 8 months of service have to be rounded off to 21. 20 year, 8 month have to be rounded off to 21. 20 year, 4 month have to be rounded off to 20 only. Part thereof in excess of 6 means more than 6 months service if you have to consider it as 1 full year. Are you all here? Okay, 1 second, I think there is some problem. Yeah, rounded off to 1 year, yes. So moving on to the, okay, what happened? Yeah, so moving on to the next one, tax Raniya. Padu solli kodutha na yaru? They. It's not fair, okay? Do you have Telegram channel? No. No Telegram channels. Yeah. So listen. You're asking Raniya? This is revision class, okay? All right. So the point is salary equals basic salary plus DNS allowance. No. DA forming part or not, you have to consider. Simply they say DA means whether it forms part of the retirement benefit or not, you have to consider. Excess, 6 months, 1 day, excess. Exact 6 backwards. Part thereof in excess means there should be something more than 6. Yes. So moving on to the next one, friends. You are receiving gratuity, but you are not covered under any Payment of Gratuities Act. In that case, you tell me how to compute the exemption. Again, exemption shall be least of the following. Which all are the limits? Number 1, same 20 lakhs. Then, actual gratuity received. Then, third limit is a little bit different. What is the third limit? 1 by 2 into. Rather than saying 15 by 26, they directly said 1 by 2 into. Based on average of last 10 months salary into completed year of service. Listen, what is this based on? Last 10 months salary based on average of last 10 months salary. What is that? What do you mean by based on average of last 10 months salary? First of all, let's understand what is the definition for salary over here. Can you read the definition for salary? Salary equal to basic salary plus DNS allowance if forms part of retirement benefit plus commission which is expressed as fixed percentage of turnover based on last 10 months average salary immediately preceding the month of retirement. So we have to understand what exactly is this. Do you remember this much? This much. It is also called as what? Listen, say basic salary DA forms part of retirement benefit plus commission, which is expressed as fixed percentage of turnover, means what, friends? Standard salary. Are you with me? So this limit simply means, say, today I am retiring. Are you all with me? Today I am retiring. Today's date is, say, imagine it is 31st July. Okay. So on 31st July 2024, I am retiring and I'm receiving gratuity, but I'm not covered under any payments of gratuity tax. Are you all with me? I've received gratuity, but I'm not covered under any payment of gratuity tax. How do you compute the third limit in category 2? Rupees 20 lakh is limit number 1. Number 2, the actual gratuity received. Number 3, how do you compute? Half into compute last 10 months average salary. How do you compute last 10 months average salary? You compute last 10 months standard salary, but when you compute that, it should be based on last 10 months average salary immediately preceding the month of retirement. What does that mean? Here they are not simply saying last drawn salary. Rather what they are saying is your retirement month is July. Are you with me? Last 10 months means till June. That means June, May, April, then March, February, January, December of last year, 1, 2, 3, 4, 5, 6, 7, then November, October. Add, then divided by 10. This is how you find out the average. But don't include July salary. Are you with me? Don't include July 2024's salary. Are you all with me? Read this again. Based on last 10 months average salary immediately preceding the month of retirement. Are you all here? This is important because if I'm right, I think in November 23 or I'm not sure whether it is November 23 or May 23, they've asked the question. In that question, say for example, it was like the different month, different salary it was. Different month, different salary. So you have to compute it in a precise manner, otherwise your answer will go wrong. And one more thing is there. Say before the retirement, if there is no change in the salary, then 10 months average salary means last drawn standard salary. Are you with me? Say if there is no change in my salary, there is no hike in my salary for the past 10 months, then last drawn salary will be the last 10 months average salary. Are you all with me? So read that again. This is important. Read that again. What is the third limit? 1/2 into based on average of last 10 months standard salary. But you're taking that average, exclude the month of retirement. That's it. Exclude the month of retirement. Before that, you take the 10 months standard salary and average it into completed year of service. Here something again is missing. What is that? They are not saying part thereof in excess of 6. So what to do? They are not saying part thereof in excess of 6. When they simply say completed year, that means completed year. Are you all with me? No round off applicable. When they simply say completed year, don't round it off. Completed year means completed year. Say 20 years and 8 months service, then 20 years. Ignore fraction. Are you all here? We can say ignore fraction. Only completed year you have to consider. That's what the department says. So salary, hope you remember the definition. If you are covered under payment of gratuities act, then basic plus DA, whether forms part of the retirement benefit or not. And if you are not covered under payment of gratuities act, it is standard salary but excluding the month of retirement. Are you here? Is that clear? Online friends respond. Again, you are sticking on to 6 months round off. Okay. I hope you got it. Okay. Super. So moving on, friends, it is how you have to compute the treatment. You have to compute the gratuity. So again, listen, in examination, they will give you gratuity. Always check whether it is at the time of retirement or death. If it is not at the time of retirement, not at the time of death, then it will be during the period of service. If it is during the period of service, fully taxable irrespective of the category of employee you are. Are you with me? Moving on to the next item. What is the next component in salary? Can you read the heading? Treatment of leave salary or leave encashment under section 1010AA. What is leave salary or leave encashment? What do you mean by that? Instead of availing leave, I encash that particular thing into money. Say for example, in my company is giving 30 days leave every year. My company is giving what? 30 days leave every year. Instead of taking that 30 days leave, I completely worked. I haven't taken any leave. That also means I've worked for an additional 30 days. Yes or no? My company is giving 30 days leave. Okay, kindly show gratuity patch. This is the gratuity page, okay? My company is giving 30 days leave for every employee. Me, instead of taking that particular leave, I work for the complete period I've worked. I haven't taken any leaves at all. So what I have to do is, I can ask for an extra 30 day salary. And that salary is said to be what? Leave encashment. Are you all with me? Are you all with me? That salary is said to be what, friends? Leave encashment. Now let's understand how to treat the leave encashment. So let's read what exactly is that. Leave encashment means unavailed leave credit encashed by the employer, not employer, it is employee. Employer need not encash any leave, okay? So employee. So listen friends, leave encashment also can be divided into two. In certain employees will accumulate all the leave, and encash it at the time of retirement. Are you with me? Are you with me? So certain employees will accumulate everything and they will encash it at the time of retirement. In certain company, it is not allowed. Every year, either you have to take a leave or you have to encash it. In certain company, it is like that. So if you are encashing your leave in the period of service, it will be fully taxable. If you are encashing your leave during the period of service, that means every year you are encashing the leave, or you are encashing the leave during every year, maybe due to the company policy or voluntarily, whatever it is, doesn't matter. The entire leave salary that you get will be fully taxable. Is that clear? Is that clear? Now, what is then the exemption? If you encash the leave salary at either at the time of retirement or superannuation, then you will get an exemption, and that's what we are about to discuss. So if you want to claim exemption, you need to encash the leave salary only at the time of very good. Now the sign is coming, okay? Whether you had a heavy lunch or not, the results are coming, about to come. Now, tell me, if you want to claim an exemption in regarding leave encashment, then you need to encash it at the time of dash retirement. Are you with me? Either at the time of retirement or resignation, superannuation. You're retiring early or resigning early. So, or otherwise, whatever it is. Now let's understand how to claim that particular exemption. That can be divided into two by a government employee. When they simply say government employee, that includes both the center and state. When they say central government employee, that means it is only central government employee. When they say state government employee, that only means state government employee. When they simply say government employee, it includes both the center as well as state. Are you with me? Are you with me? The point is very simple. If you are a government employee and you're receiving leave encashment, fully exempted. Don't pay any tax. Are you with me? But that leave encashment have to happen at the time of retirement. That's it. If it is received during the period of service, whether you are government or not, it will be fully taxable. Now, what if you are other category employee? By other employee, that means you are a private sector employee. Then what to do? Very simple. The exemption shall be least of the following. The exemption shall be what, friends? Least of the following. And we have how many limits? 1, 2, 3, 4. We have 4 limits under that. And let's understand all the 4 limits. Can you read the first limit? It's a statutory limit of rupees 25 lakhs. They are saying rupees 25 5 lakhs as limit number 1. What is limit number 2? Actual leave salary encashed. At the time of retirement, how much ever is the actual amount that you received on account of leave encashment, that entire amount you have to take as limit number 2. Can you read limit number 3? That's a little bit tricky. Can you read limit number 3? 10 months salary on the basis of average salary of last 10 months preceding retirement. What do you mean by that? 10 months salary. Okay, that is fine. And what is in the bracket? On the basis of average salary of last 10 months preceding the retirement. What is that? Very simple. You compute last 10 months average salary. Then into 10. That also means what? Last 10 months average. Are you with me? At certain time department is like this. Certain things you can say like this, but they will never say. They will go somewhere else and they will come back. Are you with me? So very simple it is. Last 10 months salary. You take the total of last 10 months salary. Here salary have a definition. And what is the definition? You tell me what is the definition for the salary? Basic salary plus DA forms part of the retirement benefit plus commission which is expressed as a fixed percentage of turnover of the employer. Are you with me? What is that? Okay, whatever it is. So I hope it is clear. Okay. So same as gratuity. Okay, whatever it is. So coming back to the point, friends, what is our salary here? Standard salary. So last 10 months standard salary is limit number 3. Is that clear? Is that clear? First limit is 25 lakhs. Second limit is actual amount received. Third limit is last 10 months standard salary. Here last 10 months means including the year of retirement. Simply last 10 months means you take simply last 10 months. But in gratuity, not covered under Payment of Gratuities Act, excluding the year of retirement. That's how the rule is. Are you here? Are you here? Now, third limit is the trickiest out of this. Can you read the third limit? Cash equivalent of unavailed leave based on last 10 months average salary to his credit at the time of retirement. Can you read this much again? Forget about the note. Can you read this much? Cash equivalent of unavailed leave based on last 10 months average salary to his credit at the time of retirement. What does that mean? When you retire, you first go check how many number of days of leave you have. Are you all with me? When you retire, you go and check how many number of days of leave you have. That is the leave credit. You encash, you convert that into money terms. You convert that into what? Money terms. To convert that into money terms, how do you convert that? You take the number of days divided by 30, you will get monthly how many months of credit you have. Then you multiply it with that with the what? Last 10 months average standard salary. Are you all here? Very simple. Read this again. Cash equivalent of unavailed leave based on last 10 months average salary to his credit at the time of retirement. So simply you go check how many number of days of leave you have at the time of retirement. You take that number of days, convert it into months. How do you convert it into months? Take 30 as standard. So days divided by 30 will give you that number of months left. That month have to be multiplied by the last 10 months average standard salary. You will get a figure. That figure is limit number 4. Have you understood? Otherwise, don't worry. After this, I'll give you again a basic problem to give you a better clarity over that point. Okay? Don't worry. Don't worry. I was actually not planning for basic problems. But when I see your face, certain people are, it is like that. Okay? Don't worry. So I'll give you one basic problem here as well. So don't worry. So listen. And there is a note under that. That note is even more confusing. What is that note? Earned leave entitlement cannot exceed 30 days for every year of actual service. Can you read this box again? Read that entire box again. So listen, friends, we will create an example for a better clarity over this provision. So listen, shh, listen. Say, one second, it's not moving. So listen. We will create an example to make you understand what exactly is that particular third limit. So listen, say there is a company called KSA Limited, okay? The பேரு வேணாமா? வேற பேரு வைக்கணுமா? Okay. Say ABC Limited there. I don't know why guys are like this, okay? So say there is a company called what? ABC Limited. Problem solved, right? So this company's policy is every year, please listen. I have no plans to repeat examples, okay? So please listen. This company, JK Limited, don't worry. It's only the first day, 2, 3, 4 and all full JK Limited. Okay. So listen, ABC Limited is a company, and according to the company policy, every year the company is providing 40 days leave to all the employees. Are you with me? So every year a company is giving how many leaves? 40 days to every employee. So there is a person called Mr. A. Mr. A is one of the employee of that particular company, and he have around 20 years of service. He have around how many years? How many years? 20 years of service in that particular company. 20 years of service, he is retiring. He is retiring from that particular company. And during that entire 20 years, he took around 100 days of leave. He took around 100 days of leave. So this only 100 days, his leave was only for 100 days. Now, friends, listen. The employer will pay him leave encashment based on the actual leave credit. Yes or no? Yes or no? The employer will pay him the leave salary based on his actual leave credit. And how much is the actual leave credit? How much is the actual leave credit? What is leave credit? The balance leave he have. So 40 days per year into how many years of service he have? 20 years. That will make it 800 days. He took only 100 days of leave, and the balance will be 700 days. His actual leave salary will be for 700 days. Are you with me? He will get actual leave salary for how many days? 700 days. But there is a note in Income Tax Act. And what is that note? What that note says is, can you read the note? Earned leave, this one. Earned leave entitlement cannot exceed 30 days for every year of actual service. Whatever the company policy is. Every year leave entitlement should not be more than 1 year leave entitlement should not be more than 30 days. Now, when you compute the fourth limit, what will happen to the leave credit? Even though you have how many years? How many days? 700 days balance. What you need to do is, your company policy is 40 days per year. That have to be recomputed to 30 days into how many years of service? 20 years of service. So the total eligible leave should only be 600 days. From that, you need to deduct 100 days of actual leave. And for the computation, take only 500 days. Are you with me? This have to be converted into months. How do you convert it into months? 500 days divided by 30 days per month. And how many months will be there? 60.67 months. 16, okay. 16.67 months into last 10 months average standard salary. Whatever the figure comes in, that will be limit number 4. Are you with me? Are you with me? We will read that box again. Read this. Cash equivalent of unavailed leave based on last 10 months average salary to his credit at the time of retirement. No problem. But there is a problem. What is the problem? Earned leave entitlement cannot exceed 30 days for every year of actual service. If the company policy is 20 days per year, then you have to compute according to that only. If the company policy is 25 days per year, no problem. If the company policy is 35, there is a problem. Maximum it shouldn't be more than 30. Maximum it should be 30. Is that clear? Is that clear? And here the salary means what salary? Standard salary. So let's solve a small basic question to make it more clear. So this question is actually in 2 pages, okay? So just go through this question, friends. This question number 5. No, not question number 5. That is gratuity. Question number 7. Just go through this question number 7 and give me the answer. It's your institute study material question. It's a fantastic question, but just quickly solve that question and give me the answer, friends. If gratuity is received in earlier previous year from, gratuity received in earlier previous year from former employer and received from another employer in later year, then the limit of 20 will be reduced by the received and the amount of exempted in earlier or not. Yes, that's right. Say, I have already retired from one employer and have claimed, say, 8 lakh as an exemption. And I'm again retiring later from another employer, then the 20 lakh limit have to be 20 minus 8. It should be 12. Yes, Abdullah, you're right. Here we need to include the month too in 10 months. Yes. Retirement month also you have to consider. Only in gratuity, that too, you are not covered under Payment of Gratuities Act. You can exclude the retirement month. Apart from that, it is normal way only. So hope you have an answer. How many of you have an answer? Very few. What happened to the others? Listen, Mr. Gupta retired on 1/12/2023 after 20 years and 10 months of service. So, receiving leave salary of 5 lakh. Other details of his salary income are given. Basic DA commission, bonus, leave availed during the service, entitled to 30 days leave credit every year. You are required to compute the taxable leave salary, assuming he is a government employee. Very simple. Fully exempted. And what is the second one? He is a non-government employee. If he is a non-government employee, you have to compute the limits. Do you remember the limits? What is limit number 1? Non-governmental employee. Limit number 1 is rupees 25 lakhs. What is limit number 2? Actual leave encashment received. How much is the actual leave encashment received? They have received an amount of rupees 5 lakh. So 5 lakh is the actual leave encashment received. And what is limit number 3? Last 10 months salary, that too based on the average of 10 months standard salary. You can simply take last 10 months standard salary. Are you with me? So last 10 months standard salary, for that you need to compute the standard salary. How do you compute standard salary? Basic salary. How much is the basic salary in the question? 5,000 per month, and in that there is a twist. What is the twist? 1,000 was increased with effect from 1st April 2023. Now, my question is this 5,000 inclusive of that 1,000 or exclusive of that 1,000? Inclusive, because the details are Gupta retired on 1/12/23. Sorry. After 20 years and 10 months of service. Receiving leave salary of 5 lakh and other details of a salary income are. That means these information is as on 1st December 23 at the time of his retirement. On 1st December 2023, he already have an increment because it is incremented from 1st April 23 onwards. So this 5,000 includes that 1,000 increment. This is after increment that 5,000. So what you need to do is, let's take last 10 months standard salary. So how much is the last 10 months standard salary? Basic salary for, when is the year of retirement? Sorry, month of retirement? October, right? Sorry, December, right? So what is the last 10 months? November, October, September, August, July, June, May, April, February, March and February. March and February. Listen, November it is 5. October it is 5. September 5, 5, 5, 5, 5, 5. This is 4. And the last one is also 4. So can you help me? How much is the total amount? Oh, sorry. Chat box is on. Yeah. So can you help me? How much is the total last 10 months basic salary? It will be 48,000. In exam, you don't have to write like this, okay? Why I am writing like this? Because otherwise you will ask me, Sir, how did it become 4,000 into 2 into 3 into 4? That's why I'm elaborately writing everything in order to avoid the repetition only. Don't think that I don't have any other job, okay? This only for the absolute clarity I'm writing everything. Are you all here? Yes, all right. Yes. So, yeah. So, moving on to the next one. Basic salary is there. How about the DA, friends? How about DA? DNS allowance total 3,000 per month, but only 60% of it forms part of the retirement benefit. So 3,000 into 60% will be 1,800 into 10 months will be 18,000. Are you with me? So DA for the 10 months will be 18,000. Now, how about the commission? Commission, ignore. Why ignoring it? Because it is not given as a percentage of the employer's turnover. Rather, they are saying simply 500 per month. Every month you will get 500 irrespective of the turnover. That you have to ignore. So 18 plus 48, and how much will be the total? 66,000 is the last 10 months standard salary. Are you with me? Last 10 months standard salary is 66,000. So that is limit number 3. Last 10 months standard salary should be limit number 3, that is 66,000. How do you compute limit number 4? So there is limit number 4. To compute limit number 4, first of all, you need to compute the number of days of leave credit at the time of retirement. So how about the eligibility? He has entitled to 30 days leave every year. Okay, so the company normally gives 30 days leave every year. How many years of service he have? 20 years and 10 months. So the question is, what to do with the 10 months? Ignore. They are not at all saying anything in relation to the fraction. So always ignore. Only once you complete a year, you are eligible for that year's leave credit. Are you with me? Only if you complete a year, you will be eligible for that year's leave credit. Otherwise, you will not get it. Are you with me? So, the point here is, say 20 years into 30 days per year will be how many days of leave? 600 days. You don't need to limit it because the company's policy is also exactly 30. If the company's policy is different, then you have to recompute it. Are you with me? Now, how many days you have? How many days of leave you have already taken? Leave taken will be 480 days. And can you help me with the math? 120 days. This is the total days of credit you have. Now you need to convert it into months. How do you convert it into months? 120 day divided by 30 and into we will complete it together. 120 day divided by 30 into 66,000 divided by 10. Not into 66,000, because 66,000 is the total 10 months standard salary. You need to take the average. How to take average? Total 10 months standard salary divided by 10. So that will be 6,600. And can you help me with the math? 26,400. And you tell me whichever is lower. 26,400. Obviously. Then only your answer will go wrong in exam. Because the other two limits are very simple. Okay. So obviously this will be the lower amount, and this is the exemption that you can claim. Is that clear? Is that clear? So come back to this last box again. Read this last box. Cash equivalent of unavailed leave, that too based on last 10 months average salary to his credit at the time of his retirement. And while computing that, earned leave entitlement cannot exceed 30 days for every year of actual service. This is what the department says. Is that clear? Okay, so what's your doubt? Sir, is in same sum leave credit is given as 35 days, then what happened? Then you compute it 30 into 20. That's it. Will you take advance tax, TDS, TCS within 4 days? No, da. Actually, I'm planning to cover only the basics and computation of total income. Advance tax, TCS, no, impossible. That itself will take at least 2 days. I require this. Advance tax, TCS, TDS, that itself will take 2 days. No, I'm not planning to cover that. I'll be only covering important topics on the 5 heads and computation of total income, including BAC and old slab rate difference and surcharge and cess. That's it. Yes. So I hope you guys are with me, and let's move on with the next concept, that is treatment of provident fund. And let's understand what is the treatment of provident fund right now. So listen. Before understanding provident fund, first of all, let me tell you this. This topic is actually very simple. Sir, why we didn't add commission? Because it is fixed commission, that's why. So, before we take provident fund, let me tell you one thing very clear. This provident fund looks very complicated. Are you all here? But this is actually very simple. But I want you to be extremely attentive, otherwise you will easily go wrong in this topic, because there are different types of provident fund. Each type of provident have a treatment when you deposit as well as when you withdraw. So you have to study everything, because we don't know in exam whether they are about to give either deposit or withdrawal. Are you all here? Are you all here? So 4 types of provident funds are there. Can you read the first type? SPF. What is SPF? Statutory Provident Fund. Second one, RPF. What is that? Recognized Provident Fund. Third one, URPF. That is Unrecognized Provident Fund. Fourth one, PPF. That is Public Provident Fund. Can you read the note under SPF first? Statutory Provident Fund means governed by Provident Funds Act 1925. It applies to employees of government, railways, semi-government institution, local bodies, universities and all recognized educational institutions. Very simple. If the Provident Fund is as per the Provident Fund Act 1925, then that Provident Fund is said to be what? Statutory Provident Fund, because it is as per the 1925 Act. Are you with me? Now, who maintains that Provident Fund under Statutory Provident Fund? Government employees, railway, semi-government employees, etc. Are you all here? Are you all here? Second type of Provident Fund. What is that? Recognized Provident Fund. Means what? Means a Provident Fund recognized by the Commissioner of Income Tax for the purpose of income tax. Very simple. Say there are certain institutions like LIC where you can maintain your Provident Fund. Say for example, I am a company. I don't want to maintain my own Provident Fund, so I can rely on LIC. I can open a Provident Fund account with LIC or any other recognized institution in India. Or I have one more choice. I can open my own Provident Fund, appoint a trustee and get it recognized with the department. Both are called as recognized Provident Fund. Either my own fund which have a recognition, or a fund which is maintained with an already recognized institution. Both are called as what? Recognized Provident Fund. Say company like Tata and all will always go for their own fund because their size is very big. Are you with me? Are you with me? So that is called as what? Recognized Provident Fund. What does that mean? A fund which is recognized by the Income Tax Act. That's it. Now, third one. What is that? Unrecognized Provident Fund. URPF. Means what? A fund not recognized by the Commissioner of Income Tax. Today morning, I started a fund. Okay, I am calling it as Provident Fund, but I didn't take any recognition. Then it will be considered as a URPF in the eyes of law. Are you with me? And what is the last one? PPF. What is that? Public Provident Fund. Can you read the definition? Operated under Public Provident Fund Act 1968. A membership of fund is open to every individual. For example, I am a professional. I'm not employed with anyone. I'm actually a practicing as well as a teaching chartered accountant. So I'm not employed with anybody. I thought of opening a Provident Fund. I thought of what? Opening a Provident Fund. I can open it with a scheduled or a nationalized bank, and that Provident Fund will be called as what? Public Provident Fund. I will get certain benefits if I deposit amount to this Public Provident Fund. Are you all with me? 4 types of Provident Fund have 4 purposes. SPF means statutory. RPF, recognized. URPF, not recognized. And PPF, self-voluntary. I'm not an employee, or employees also can start a parallel Public Provident Fund. They want more savings. They can what? Start a parallel Public Provident Fund, but that is not that attractive for them because already they have a Provident Fund with the employer. Are you with me? Are you with me? Yes, sir. And we have treatment. There are 2 set of treatments in income tax. Number 1, at the time of deposit. Deposit means, I've told you that Provident Fund is like both the employer as well as the employee have to invest in Provident Fund. That fund will grow with interest and you can withdraw a lump sum amount at the time of retirement or death. Is that clear? Now, we have to understand what is the income tax treatment at the time of deposit as well as at the time of withdrawal. So, we are about to discuss both. First, at the time of deposit, later at the time of withdrawal. So different funds have different treatment, and that's what we are about to discuss in this table format. Can you read the heading? At the time of deposit. Let's understand what is the treatment of this provident fund at the time of deposit. So listen friends. So at the time of deposit simply means statutory update. There is no statutory update. There is only one statutory update. That is 194BA in TDS. That is TDS on online games and all. That I'll tell you at the time of IFOS. Okay. That is only one new section. So listen, at the time of deposit, let's understand. So the first one is SPF. Second one is RPF. Third one is URPF. Fourth one is PPF. First, let's complete SPF. What is SPF? What is SPF? So listen, the statutory provident fund have both the employer as well as employee contribution. I'll give an example, and based on this example only we'll be explaining this provident fund. So please listen. Don't make me repeat this example. So please listen. Say there is an employer, and there is employee. Say employer is ABC Limited, some company, and employee is Mr. A. Okay. Now listen friends. Say for example, it's ABC Limited every month is paying 1 lakh rupees as what? Salary to Mr. A. This ABC Limited is paying how much salary? 1 lakh rupees as salary to Mr. A. So when they pay this 1 lakh rupees, this employer will deduct what? Provident fund contribution of employee. The employer every month will deduct what? Provident fund contribution of what friends? Employee. Are you all with me? Are you all with me? 1 lakh is the salary. From that salary, he will deduct that employee's provident fund contribution. Say it is 10,000 rupees. Contribution is how much friends? 10,000 rupees. So ineffectively, this employee will get only how much in his hands? 90,000 only in his hands. This deducted amount of 10,000. And he also will take another 10,000 from his pocket. That is employer contribution. And all together this employer will deposit how much? 20,000 rupees to that particular provident fund. Are you with me? So how it become 20? 10,000 from employee and 10,000 out of his pocket. Out of his pocket, and 10,000 from the employee and 10,000 from his own pocket, he will distribute or deposit it in the provident fund account. Are you with me? This will happen every month. This 20,000 deposit will happen every month. Every year there will be interest on employer contribution and interest on employee contribution. And towards the end, that amount will become a lump sum amount and the employee can withdraw it. Are you all with me? This is how that fund works. So based on that fund's operation only, Income Tax Department have set the taxation. Now let's understand how exactly is the taxation. So listen, we are about to discuss, and one more thing is there. You tell me, what is the salary of the employee now? How much is the salary of employee? According to income tax law, his salary is 1 lakh. His salary is 1. You are earning 1. You are depositing that 10. It is just like you got that 1 and you are investing it in provident fund. Are you with me? It is just like you got that 1 and you are investing that 10 in provident fund. Your salary is 1. You have to show 1 lakh rupees as your salary, but you will get a deduction for that investment. That is the concept. Are you with me? Ultimately, what you said is right. But the correct treatment is you have to show 1 as your salary and 10,000 have to be a deduction. That too under Chapter 6A, 80C. Are you with me? Are you with me? So friends, listen. So what we need to do is, so in such a case, let's first of all understand what is the treatment when you deposit some amount in SPF. So first of all, can you read this? Employer's contribution. When an employer deposit an amount for the benefit of employee to a SPF, you tell me, is employee getting a benefit? Logically think and tell me, when employer every month deposit this 10,000 for on behalf of employee from his pocket, is employee getting a benefit? Yes, he's getting a deferred benefit. Not immediate benefit, but he's getting a deferred benefit. In future, you can withdraw that entire money and enjoy. Yes or no? So department say you are getting a benefit, so normally it should be what? Taxable. But if you are depositing, if the employer is depositing to a SPF, that deposited amount shall be fully exempted. You don't need to pay any tax for that. That's why it is written not taxable. Are you with me? Are you with me? So, listen. Employer's contribution to SPF shall be fully exempted, or rather we can say shall not be taxable. Are you all here, friends? Now, how about employees' contribution to Provident Fund, statutory Provident Fund? What will happen? Eligible for deduction. Even though you have to show that entire 1 lakh as your salary income, you can claim a Chapter 6A deduction. You tell me from where you claim this Chapter 6A deduction? Very good. Okay. So listen. I thought you are good in your basics, okay? No worry. I'm not teasing you or complaining and all. It was just a thought, like I should have started with the core basics. So listen. Say, in the morning I've told you, there is a taxing rule. Yes or no? Do you remember that? What is the taxing rule? Residence rule and source rule. Okay, say you have received an income. The second thing to check is what? Whether it is taxable in India. To tax that, we have two rules. Number one, residence rule. That means taxing according to the residency status. ROR, global income will be taxable. RNOR, accrued, first received, and income accrued outside India due to business control or profession set up in India will be taxable. NR, you have to apply source rule. First receipt or income accrued in India. Are you with me? What will happen if an income is taxable in accordance with the residence rule and source rule? You need to process it under different heads. Income means gross income. You don't have to pay tax for the gross income. You can always claim expenses, exemptions and other things. This processing of gross income will happen under different heads. Are you with me? Are you with me? So if an income forms part of scope of total income. What do you mean by forms part of scope of total income? By applying residence rule or source rule. You apply residence rule and source rule, and if an income is taxable, you don't have to pay tax for that entire income. Then what you need to do is, you need to split that income into 5, or you need to process that income under 5 heads. You tell me which all are the heads? Salary, house property, PGBP, capital gains, IFOS. Are you all with me? Because each type of income depends upon its character only, the processing should happen. Say for example, from PGBP income, there is no standard deduction. From house property income and salary income, you can claim standard deduction. If it is capital gains, you can claim cost of acquisition. From PGBP income, you cannot claim cost of acquisition. Are you with me? So each type of income have its own character. So they are splitting that into 5 heads. Are you all with me? You have to process an income under respective head. You have to process incomes under the respective head. Then you will get the income from salary, house property, capital gain and IFOS and PGBP. Then the next process is, you need to add everything together. You need to add everything together, and this figure will be said to be what? Gross total income. You need to add everything back together, and that total is said to be what, friends? GTI. That is gross total income. While adding that, this addition is subjected to 2 set of rules. Number 1, clubbing. Number 2, set off and carry forward. When you add this from the respective heads, those addition is subjected to two set of rules. That is said to be what, friends? Clubbing and set off. Now, from the gross total income, you can deduct what? Chapter 6A deductions. That is from 80C to 80U. From 80C, it starts from 80C, ends with 80U. You can claim all the chapter 6A deduction from the gross total income, and the figure that you get after this is said to be what? It's simply said to be the total income. This is the technical name. And on the total income, you have to apply the rate of tax. How do you apply the rate of tax? What is the thumb rule? Not always slab rate. There is a thumb rule for taxing an income. And what is the thumb rule? I'll tell you. Listen. You can split this total income, or you have to split this total income into two. Number one, yes. For certain total income, rates are provided in the IT Act itself. In such case, then, in such case, apply such rates. What is that? Example, long-term capital gain under section 112 at 20%. Casual income under section 115BB at 30%, etc. Are you with me? For certain types of total income, income tax department in the IT Act itself, they are providing for flat rates. If your total income is in that category, you apply those flat rates. This is number one. Are you with me? This is the thumb rule for taxing an income according to the income tax law. Now, we have one more thing. And what is the second thing? Other incomes. Other incomes, you apply slab rates. That is rate as per the Finance Act. We normally say it as rate as per the Annual Finance Act. In common layman's language, not layman's language, commonly we call it as what? Slab rates. Are you with me? Are you with me? If you apply these two, you will get dash tax. What tax? Basic tax. You will get what? Basic tax. You will get basic tax only. From the basic tax, you need to add together your basic tax. So take total basic tax. From the basic tax, you have to apply surcharge. Surcharge. Again, surcharge can be divided into two. What are the two types of surcharge? There are two types of surcharge. Number one, fixed surcharge. Fixed surcharge means for certain type of income, you have to mandatorily pay surcharge. That is said to be what? Fixed surcharge. And the other surcharge is surcharge depends on total income. Total income size, we can say. What is total income size? Individual, you having a total income of more than 50 lakh. Normally 10%. More than 1 crore, 15%. More than 2 crore, 25%. More than 5 crore, 37%. This I will cover in computation of total income. Normally in my regular class, this is a basic concept, but it will take 1 day to complete everything. Because we have only 4 days. So I cannot spend that much time for the basics. So that's why I skipped basics, but don't worry. So you apply the surcharge rate and add these together, then you will get what? Basic tax plus surcharge. And it is subjected to what? Health and education cess. On this figure only, you are supposed to apply 4% cess. You apply this, then you will get what? Tax liability. Including surcharge, cess and basic tax. How do you pay this tax liability? For paying tax liability, there are different methodologies for the payment of tax liability. Number one, TDS. The person who pays you the income will deduct the tax. Are you with me? That is called as tax deducted at source. Number 2, TCS. When you buy certain goods, you have to pay income tax portion or a percentage of the value of the good purchased as income tax to the seller. Something similar to GST. Buyer have to pay a percentage of the value of the good he purchased as tax to the collector. That means to the seller. Seller will deposit on behalf of the buyer. It is called as TCS. Then there is another method that is called as advance tax. That means tax which is paid in the running PY itself. And finally, self-assessment tax. That means tax which is paid after the PY, before you file your return. Now you have one more duty. What is the duty? You need to communicate all this information to the income tax department. That is called as filing return. You need to communicate everything to the department. You only know how much income you have. You only know how much expenses you have. You only know how much are your deductible investments. So you communicate everything to the department by sending a statement that is called as filing return. Are you with me? These are the chapters that you have to study in your CA inter syllabus. You check your institute study material. It will start from basic concepts. Chapter 2, residency status. Chapter 3, salary. Chapter 4, house property. Chapter 5, PGBP. Chapter 6, capital gain. Chapter 7, IFOS. Chapter 8, clubbing. Chapter 9, set off and carry forward. Chapter 10, Chapter 6A deduction. Chapter 11, I think TDS, TCS advance tax. Chapter 12, filing of return of income. Chapter 13, computation of total income. Computation of total income means you compute the basic tax, surcharge, cess, then this. That's it. Come again? Rebate also will come, but rebate there is a condition. From the basic tax only you have to compute the rebate. There are many things in between. I only given you an outline. Okay. Rebate is under 87A. That means you can claim only rebate if your total income is 5 lakhs or less in the old scheme, 7 lakhs or less in the new scheme. It is like that right now. Are you all with me? Are you all with me? Now you tell me from what figure you have to deduct Chapter 6A reduction? From gross total income. First of all, you should have an idea of what you are studying. This is the tax universe for CA inter. This is it. We cannot actually split it chapter wise because we can easily frame a question which involves everything. Okay, we can easily frame a question which involves every chapter. Very easy it is. You have to expect that kind of a question for at least 12 or 14 marks. There will be one question will be like that. That is computation of total income question. It will carry at least 12 or 14 marks usually. Are you all here? Now, you tell me from which figure you can claim that Chapter 6A reduction from your GTI. What is GTI? Gross total income. Now, coming back to our main thing. Okay. So, we were discussing what? The Provident Fund. All right. Now, we were discussing about the statutory Provident Fund, and listen, if an employer, don't worry, okay? Don't worry. This happens in a revision session because always I assess my students. I have no predetermined agenda. It always depends upon how the students are. Are you with me? If you're so good in basics, I would have simply completed this right now. But don't worry, this is actually a classroom for learning. Our ultimate objective is to qualify CA inter, not to demonstrate your knowledge and not to demonstrate my knowledge. Are you all with me? Are you all with me? So listen friends, coming back to that particular point. So where were we? We were discussing situations, TCS. Okay, connected. Okay, very good. Pakka review, overview. Thank you. Motivation is coming in between. Yeah. So actually these are good only. Okay. Yes. So tell me friends, if an employer deposits something to a SPF. What is SPF? Statutory Provident Fund. Don't worry. Nothing taxable in the hands of employee. Don't think about employer. Employer, it's a cost. We are talking about the income tax. So you should think about the income perspective. It is the income of the employee, not an immediate income, deferred income. But don't pay any taxes. We have no plans to tax it. Are you with me? An employee, when he contributes something to SPF, I've already told you that our income will be 1 lakh. In our return, the employee will show rupees 1 lakh as his income. Are you with me? Are you with me? But you can claim that 10,000 rupees as an 80C deduction. So you should not claim it from the salary income. Rather, you should compute your salary income, house property, PGP, capital gain, IFRS, then you compute the GTI. Under GTI, under section 80C only, you are supposed to claim it as a deduction, that 10,000. Is that clear? If you claim it from the salary income, your numerical will be right. But your income from salary will be wrong. Your GTI will be wrong. Your chapter 6A deduction will be wrong. And they will assume that your total income is also wrong. From there onwards, you will lose marks. Don't think about the mathematical effect of it. This is a law. This is a rule. You have to follow this. It is mandatory. Coming back to the point. So, if the employer is contributing to SPF, nothing shall be taxable. If the employee is contributing to that particular SPF, your already taxable income is 1. That 10 you have contributed, you can claim as a deduction. Now, what will happen to the interest? Read. What will happen to the interest portion? I've told you that every month, employer as well as employee is contributing to the fund. Yes or no? Every year you will get what? Interest. Every year's interest is fully exempted. Nothing to worry. So the point is very simple. If you are maintaining an SPF. What is SPF? Repeat. Statutory Provident Fund. If your employer contributes something for your benefit, not taxable. If you yourself are contributing to that, you can claim that contributed amount as deduction under 80C. And the interest that is getting accrued in that particular fund will be fully exempted again. So EDE, exempted, deduction and veendum exemption. Sorry, I've used the Malayalam. So it is like again exemption. So EDE, we normally say EDE. Employer deposit, exempted. Then your deposit, deductible. And the interest, exempted. Now moving on to the second fund. Which is the second fund? Which is the second fund? In RPF also, both the employer and employee will contribute. If the employer is contributing something to that particular RPF, can you read that first paragraph? Exempted up to 12% of salary. Not like SPF. There is a limit for the exemption that you can claim. The employer every year or every month is contributing something to RPF. You can claim an exemption, but that exemption shall be maximum how much? 12% of salary of employee. If the employer is contributing more than 12%, you tell me what will happen? Excess shall be taxable as salary. Are you able to follow? Now, you tell me what is salary here? It is standard salary only. That is basic salary plus DA forms part of the retirement benefit plus commission if it is expressed as fixed percentage of total turnover. It is also called as what? Standard salary. We named it as standard salary. Only for this we named it as standard salary. Because wherever it comes, I can simply say standard salary, standard salary, standard salary. Are you with me? Are you with me? So the employer's contribution is exempted only up to 12% of standard salary. What will happen to the employee contribution? Array, read. What will happen to the employee's contribution? Eligible for deduction. You can claim deduction under 80C. Now, what will happen to the interest component? You can claim an exemption, but there is a ceiling limit. What do you mean by ceiling limit? Very simple. You jump from here, you will touch in the ceiling. You cannot jump more than this. That is called as what? Ceiling limit. Maximum amount of exemption. The top. That's why I'm showing like this. Okay. Not that a DRS. Okay. It is the ceiling limit. So how much is the maximum exemption that you can claim? Exempted at 9.5% per annum. Any excess interest will be taxable as salary. Don't ask on what amount you claim this. You tell me on what amount I claim that 9.5%. On the fund balance. What else? Are you all with me? Are you all with me? On the fund balance, if you are getting an interest, it is exempted, but only up to 9.5%. What if my actual interest is only 8%? Then fully exempted. That's it. Then that full 8% is exempted. Don't claim 9.5% and don't claim it as a loss and all. Okay, it's not possible. So Very simple. If that employer is depositing something to RPF, exemption you will get. How much? 12% of standard salary. Employee if depositing something to RPF, you will get deduction under 80C. How about the interest on employer and employee contribution? Exempted, but only up to 9.5% of the fund balance. Is that clear? Is that clear? Not yet over. We have one more fund. And what is the third fund? URPF. That is Unrecognized Provident Fund. Read the treatment of employer contribution. Not taxable. Why? Because income tax department don't know that there is a fund. If they don't, that is called as recognized. They don't even know there is a fund. So employer depositing something somewhere. Nothing shall be taxable. Then how about employee's contribution? Not eligible for deduction. Balance is here. Not eligible for deduction under 80C. There is actually a line in between. Okay. I think due to this quality of projector, you cannot see that. But I think in the TV it is visible, I think. Okay. So not eligible for deduction under 80C. And how about the interest? Not taxable. Now you will think of maintaining a URPF account. Why? Because comparatively, maintaining URPF is better than RPF. There is no ceiling limit and all. Yes or no? Not like that. You will get the taxation at the time of withdrawal. When you withdraw, that taxation will hit on you. Are you with me? So don't think that maintaining a URPF is better, because there is something huge is about to come at the time of withdrawal when you are withdrawing amount from URPF. Now, what is next? PPF. Can you read the treatment of employer contribution? Not applicable. Why? I don't have an employer. That's why I'm maintaining a PPF. Are you with me? So there won't be any employer's contribution. There will be only my own contribution. What will happen to my own contribution? Eligible as deduction under 80C. Then what will happen to the interest component? Not taxable. Is that clear this much? 4 types of provident fund. Number 1, SPF, RPF, URPF, PPF. Employer contribution in each fund. Think and tell me. I make you read. That's why I make you read. Think and tell me. Employer contribution to SPF, not taxable. Employer contribution to RPF, you will get exemption, but only up to 12% of standard salary. Then employer contribution to URPF, income tax department don't know that. So no taxability. No employer contribution to RPF. Sorry, PPF. There is no employer contribution. That is done. You've learned it. Yes or no? Those who repeat with me will learn it. Okay. So I want all of you to repeat it again and again. Now, you think about employees' contribution. Deductible under SPF. Deductible under RPF. Not deductible under URPF. Deductible under PPF. Now you think about the interest component. Interest is fully exempted under SPF. 9.5% exemption under RPF. No exemptions, not taxable under URPF. And full exemption under PPF. Are you all with me? It is simple, isn't it? This is actually nothing. Okay. So at the time of deposit, the treatment, that's what we have learned right now. Not yet over. Now we have something that is called as withdrawal. You are about to withdraw money from that particular fund, and let's understand what will happen when you are withdrawing money from the respective funds. So we will understand what exactly is the impact of withdrawal. So can you read the first heading? When you are withdrawing some money from recognized provident fund or public provident fund or statutory provident fund, you can claim some exemption, and it will be taxable if you are withdrawing money from URPF. First of all, let's complete the exemption, then we will discuss about the taxability. So can you read the first sentence? Payments received by an assessee from the following funds at the time of retirement or otherwise would be fully exempt from tax under section 10 subsection 11 and 10 subsection 12. So under 2 sections you can claim exemption. Number 1, let's understand 10 subsection 1 first. Can you read the sentence? Payment received by an assessee from statutory provident fund and public provident fund at the time of retirement or otherwise would be fully exempt from tax. Very simple. Whatever amount that you withdraw from SPF and PPF, full exemption. You don't need to worry about any taxability. Is that clear? Is that clear? And which is the section? Section 10 subsection 11. Under 10 subsection 11, it is fully taxable. Sorry, fully exempted. Now, what if you are withdrawing something from RPF? That exemption is under section 10 subsection 12. Are you with me? Are you with me? If you withdraw some amount from your RPF, then you can claim an exemption under section 10 subsection 12. Let's understand what exactly is that exemption. So what they are saying is accumulated balance payable to an employee participating in RPF shall be exempted in any of the following circumstances. The first thing is, if you want to claim exemption, you need to satisfy any of the following condition. What is the first one? Can you read the first one? You are withdrawing money after 5 years of continuous service from recognized provident fund. Don't worry, nothing taxable. Are you with me? Are you with me? You are resigning from a company or you are retiring from a company and you are withdrawing money from RPF. What is RPF? Recognized Provident Fund at the time of retirement or whatever it is. But it is after 5 years. Nothing shall be taxable. You can claim full exemption under section 10 subsection 12. Are you all here? Now you tell me, normally if you withdraw money after 5, nothing shall be taxable. That also means if you withdraw money before 5, you have to pay the taxes. Are you with me? Are you with me? But what department say? Employee retires or terminates job before 5 years of continuous service. Then what will happen? By a reason of ill health. Don't worry, don't pay us any taxes. You are resigning or you are retiring due to your ill health before 5 years. Nothing shall be taxable. After 5 years, irrespective of the reason, nothing shall be taxable. Before 5 years, due to ill health also, nothing shall be taxable. Or due to a reason of contraction or discontinuance of employer's business. That employee's business got discontinued. That is not your problem. You are willing to work more than 5 years, but that employer stopped this activity. What will I do? I am mandatorily supposed to get out or retire or resign before 5 years. In that case also, nothing shall be taxable. And what is the third case? Any other reason beyond the control of employee. Any other reason beyond the, say there is a huge economic depression. Every company, or COVID, that is the best example. Why should I complicate? COVID. Say new variant came in. Okay. Say new variant came in. Delta, alpha, gamma. A new variant came in and it's very deadly also. Then what will happen? Again, you will definitely, you will follow that COVID restriction and people will stop their business. Some persons will restrict their activity. We all will die. That is also right. Okay. Thiru say everybody will die. Then you don't have to study income tax. Yeah. So the point is, if something like that happening and you are resigning before 5 years also, don't worry. Nothing shall be taxable. Are you with me? Are you with me? So the point is very simple. If you don't have 5 years of continuous service, but you are withdrawing money due to your ill health or due to contraction of your employee's business or due to any other reason which is not under your control, no worries. Nothing shall be taxable. Are you with me? Moving on. Say you resigned. Okay. You resigned before 5 years by your own. Without any other reason, you resigned before 5 years. But you joined another company. But you joined where? Another company. Now you transferred that RPF balance from the past employer to the present employer. That means you resigned from Reliance and joined Tata. You worked for Reliance for 3 years. Then you joined Tata. So you resigned within 3 years. But no worries, don't withdraw the money. Rather, transfer that Provident Fund balance in the name of Tata and continue depositing in Tata's control. In that case, nothing shall be taxable. For the transfer, you don't need to pay any taxes. The transfer shall not be regarded as a withdrawal. Are you with me? Are you with me? Read point number 3. Employee has before completion of 5 years and joins another organization who also maintains RPF and his fund balance with the current employer is transferred to the new employer. In that case also, nothing shall be taxable. And what is the last case? The entire balance standing to the credit of employee is transferred to his account under NPS. That is referred under section 80 CCD. Okay, one thing is missing. D should be there. Okay, 80 CCD. C is missing. Sorry, D is missing over there. So that simply means you have resigned before 5 years. Instead of withdrawing the amount, you transferred that RPF balance to your pension fund. No problem. You can still claim the exemption. Nothing shall be taxable. In any other case, if you are withdrawing the money, then what will happen? Tell me, in any other case you are withdrawing money, then what will happen? It will be taxable as if it is a withdrawal from URPF, which we are about to discuss. Are you with me? In any other circumstance, if you are withdrawing money, it will be considered as a withdrawal from a URPF account. That's what we are about to discuss. Before that, somebody is asking something in online. What if RPF transfer to URPF? Normally, nobody transfers RPF from URPF. Reverse happens. URPF, you can convert it into RPF. Okay. If you're converting that, from the date of conversion only, you are eligible for exemption and all. That's it. RPF cannot be. Oh, you're saying that you have resigned from a company and you're withdrawing the money from RPF and depositing it in URPF. Is that so? Fully taxable. If you don't have 5 years continuous service. Because the income tax department does not recognize URPF. Okay, Ragul? TCS shall be collected. That is the TCS chapter. Okay. Sir, which are the circumstances where TCS shall be collected? So, what happened if RPF transfer? Okay. I think I have addressed everything. So, if I miss something, then ask again. Okay. If I miss something, then ask again. So, these are the points that you should consider while you are withdrawing an amount from. I told you that everybody will die. Yes or no? I've given you an assurance. It will be dry. It is dry only because it is law, Income Tax Act. It is not me who have written everything. It is the government who have written everything, and ICA have put it as a part of the syllabus. Now we have to study. We don't have an option, and it is a revision class also. Normally in regular, I make students solve questions in the afternoon session. We only have 4 days, so we have to discuss theory in the afternoon session. I know it is very dry, but what to do? We don't have a choice. Yeah. So friends, listen, you tell me what is section 10 subsection 12 if you are withdrawing money from RPF. We have discussed the possibilities. After 5 years of continuous service, nothing taxable. Before 5 years, but due to your health, no problem. Before 5 years, but due to the discontinuance of business, no problem. Before 5 years, which is not under your control, no problem. Before 5 years, but you transferred that balance to another RPF, no problem. Before 5 years, you transferred that RPF balance to NPS, no problem. NPS means it's not new, actually, it's National Pension Scheme. I've written new pension scheme. That means when it was at the time of introduction, it was new. Right now, it is not new. It is NPS called as National Pension Scheme. That's it. Or we can say pension scheme under 80 CCD. Now, listen. In any other circumstance, if you're withdrawing an amount from RPF, it shall be treated as if it is a withdrawal from URPF. Now, let's learn what is the treatment of URPF withdrawal. Tell me, if you withdraw some money from URPF, you have to split that withdrawal into 4. Number 1, employer contribution. Number 2, employee contribution. Number 3, interest on employer contribution. Number 4, interest on employee contribution. Hope you remember. In every fund, employer will contribute. Employee will contribute. Interest will be there on the employer contribution and interest will be there on the employee contribution. At the time of withdrawal, you are getting everything together. But the income tax depends upon the character of the contribution. So let's understand what is the treatment. Can you read the first one? Accumulated employer's contribution. What is the treatment? Fully taxable under the head salary. So the point is, at the time of deposit, department said nothing taxable. Why? Because when you withdraw that employer's contribution, that entire employer's contribution shall be fully taxable under the head salary. Are you with me? Are you with me? Yes, second one, accumulated employees contribution. What do you mean by accumulated employees contribution? My salary was 1 lakh. I deposited 10,000 out of that 1 lakh in URPF. I didn't get a deduction. In the year end, I will get that 10,000s that I've invested back. You tell me, what is the treatment? Not taxable. Nothing shall be taxable. Why? When I get 1 lakh, that entire 1 lakh is taxed as salary in the year of receipt. Out of that one, I've deposited 10. You didn't give us any deduction for that 10 deposit. Now I'm withdrawing my portion of deposit from that particular account. Do I have to pay taxes for that? No, I don't have to pay any taxes for that because it is already taxable as what? Salary. I've already taxed it as salary in the year of receipt itself. Have you understood what I said? Have you understood what I said? See, this 1 lakh, I've taken that, I deducted 10,000 and in my hands I received only 90. But my salary was 1. In the year end, these 10,000 which I've deposited, I got it back. That I've already taxed in the year of receipt itself. Now, in the year of withdrawal, I don't have to pay taxes again for my own contribution. Now, how about the next one? Interest on employer contribution taxed under salaries. Interest on employees contribution taxed under IFO. Yes, are you with me? Why? Because income tax department is considering URPF as some kind of deposit. Your employer have deposited something on account of employer-employee relationship, so that portion have to be salary. On that employer contribution, you are getting an interest, that also on account of employer-employee relationship, salary. You are getting some interest on some kind of deposit, that is IFOS. That's why employees contribution is taxed under IFO. Yes. Is that clear? Is that clear? So we have learned the impact of at the time of deposit as well as at the time of withdrawal. That's it. I hope it is clear. We are discussing about what? Provident funds impact, and we have considered both at the time of deposit as well as at the time of withdrawal. Great. Now, moving on with the next one, friends. So online friends, what are the other? Kindly show the above notes for a while. Above notes means which above notes? This one. Yeah. So these are the things that you have to discuss under what? Provident fund. Now we will move on and discuss voluntary retirement receipt. Tell me, friends, what do you mean by voluntary retirement? What happened? Break. Don't worry, I'll give you a break, okay? Our classes are till 6:30. So if I give you a break right now, next session will be very lengthy. So let me give you a break after 15 or 20 minutes. Yeah. So listen, friends, can you read the next heading? Withdrawal within 5 years notes. Withdrawal within 5 years. Okay, this one. Yeah. So tell me, friends, what about the threshold limit of 2,50,000? No. That is not required. That is another explanation. Okay. That I'm not covering because we don't require that for solving a problem. Yes, the 2,50,000 thing is another thing. Okay. I'm not covering that because normally we don't require that to solve a problem. Yeah. So listen, friends, listen. Where were we? Yeah, VRS. What do you mean by VRS? Arey, what do you mean by VRS? Seems like you all want an voluntary retirement right now. Okay. Yeah. So tell me, what is voluntary retirement? That means, say, you are retiring voluntarily before your age. What are your retirement age? Your retirement age is 60. You decided to retire at the age of 50 or 52 or whatever it is. So that process is said to be what? Voluntary retirement. During voluntary retirement, the employer have to pay employee a lump sum amount. And that lump sum amount is said to be what? Voluntary retirement receipt. Received by the employee from the employer. Are you all listening? Are you all listening? If you are an employee who is in receipt of voluntary retirement, then what income tax department say? You can claim an exemption under section 10(10)(c). And exemption shall be the lower of the following. Which all are the limits? Number 1, can you read limit number 1? Actual voluntary retirement receipt that you received is point number 1. What is point number 2? Rupees 5 lakh as the statutory limit. And what is point number 3? Amount equivalent to 3 months salary for each completed year of service. What do you mean by that? Amount equivalent to 3 months salary for each completed year of service. Mathematically it means, what is salary first of all here? What is salary? You have a definition here. What is salary? Standard salary. So what department says, you take the last drawn standard salary. That is LDS, we can say. Last drawn standard salary into 3 into completed year of service. Completed year of service. This will be limit number 3. Are you with me? You take the last drawn salary, you convert it into 3 months salary. That means last drawn salary into 3 into completed year of service. How about months? Ignore. They are not saying fraction in excess of 6 months or something. So you can ignore the fraction. How about the fourth limit? Salary at the time of retirement. That means your last drawn standard salary into balance month of service left. What is this balance month of service left? You are retiring at the age of 55. Your retirement age is 60. How many months of service you have? 5 years into 12 months. That will be 60 months into last drawn standard salary. Are you with me? Are you with me? Instead of creating an example, I'll make you solve a small question that will actually refresh you as well. So, where is it? Yeah, it's an easy question, okay. Question number 10. Quickly solve question number 10. Thiru, don't worry. While solving question number 10, I'll explain that point again, okay. Don't worry, don't worry. It is a part of syllabus. It is a part of syllabus. Okay, those thresholds are a part of syllabus, but I'm not planning to cover it in the revision session. Okay. So I'll tell you what exactly is that. Okay, don't worry. I'll tell you what exactly is that. Listen, see. What they are saying is, imagine a case, okay. I'm talking to you, Valli, I hope you hear, okay. Yeah. Valli, say for example, I'll tell you the circumstance so that you will understand, okay. Say I'm a person who have what do you say, recognized provident fund, okay. I'm a person who is maintaining a recognized provident fund. And I'm earning a lot of salary. Every year I earn a lot of salary. All right. What I'm doing is, I'm investing say 10 lakh rupees. I'm investing, see, I can increase my own contribution. Okay. Law is not saying that I should deposit this much. It is my option. When I'm investing in this recognized provident fund, I can decide the amount. Say I am investing 10 lakhs every year. If I invest 10 lakhs every year, what will happen? I'll get interest on that entire 10 lakhs. I'll get an interest on that entire 10 lakhs. If it is SPF, that entire interest is exempted. If it is an SPF, that entire interest is exempted. Okay. And what happens is in the year end, that entire withdrawal is fully again exempted. At the year end means when I retire, that entire fund balance is fully exempted again in the hands of the employee. So what I can do is, I can invest huge amount and I can earn a lot of interest income without paying income tax. Okay, they can make use of this provision to save a lot of income tax. So what government says is, if you are investing more than 2,50,000, if the employee is investing more than 2,50,000 to SPF or RPF, interest on that excess shall be fully taxable at the time of withdrawal. If the employee is investing more than 2.5, interest on that excess over 2.5 shall be fully taxable at the time of withdrawal. You cannot claim exemption. That is that note. Have you understood? In order to avoid excess exemption, they have created a provision like that. Whatever interest that you get, over and above 2,50,000 investment shall be fully taxable at the time of withdrawal. Yes. Done? Completed? Completed. All right. All good. So let's solve it together. Listen. What is the question? Mr. Datta received voluntary retirement compensation of 7 lakh after 30 years and 4 months of service. He still has 6 years of service left. At the time of retirement, voluntary retirement, he was drawing a basic salary of 20,000 per month. DA which forms part of pay. What is this forms part of pay? Forms part of employment. That means forms part of retirement benefit. That means it's an official DA. 5,000 per month. Then compute his taxable voluntary retirement compensation, assuming that he is not claiming any relief under 89. Let it be there. So which all are the limits? Can you tell me the limits? Limit number 1, actual amount received. How much is actual amount received? 7 lakh. What is limit number 2? 5 lakhs. What is limit number 3? For computing limit number 3, we require standard salary. How much is the basic salary in the question? 20,000 is the basic salary in the question. How much is the DNS allowance? And they are saying it forms part of the pay. So altogether it will be 25,000. They are not mentioning anything about commission. So they don't have, they may be not paying commission. So 25,000 is the standard salary. So third limit is 3 into 25,000 into how many completed year of service he have? 30 years and technically it is 4 months. Ignore 4. Count only 30. So into 30. Can you help me with the math? 22 lakh 50,000. Now, salary at the time of retirement multiplied by the balance number of service left. That is limit number 4. What is the salary at the time of retirement? 25,000 into balance number of service left. How many number of service he left? 6 years into 12 months. Can you help me with the math? 18 lakh. 18 lakh round figure. So 18 lakh. Whichever is lower is 5 lakh. So your exemption shall be rupees 5 lakh. Is that point clear? Is that point clear? Yes, let's start perquisites. Okay. So, tired. Think about me. I was keep on shooting provisions. All right. No worries. I'll give you a break. Okay. I don't want claps. I want you to sit more. Okay. Okay. Thanks a lot. I was not clear with the note, but now understood. Okay. Great. So we'll do one thing. Let's go for a break, okay? So go relax and come back at 5. Okay, 5. Okay, no problem. 20 minutes. But you should come exactly on 5. Yes, go. It's non-PGA. Kalai, it's non-PGA, okay?